Well, U.S. stocks retreated today based off of a trio of economic reports. We did see capital goods orders down. The Philly Fed came out and said factory activity was a little bit light. And then we did see existing home sales fall for the third straight month. So a little bit of a challenge there for the markets here today. We did see some declines across the board, but they weren't egregious enough to change the posture that we've seen here in recent times here. We continue to be bullish according to the market forecast. We're going to look at a stock that is in a quieter section of the market in our trade application and show you how to sell a put on a stock that has a higher than average dividend yield. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host Brandon Van Zee, and it's February 21st, 2019. First of all, if you are new, welcome aboard. We're grateful to have you in our audience tonight. Remember, you can go to our YouTube channel and click on subscribe. While you're over there, make sure you check out our description area and you can sign up for our email distribution list that entitles you to not only receiving notification when we post the videos, but also giving you a heads up on what stocks in the S&P 500 are giving you overbought and oversold cluster signals. In addition to YouTube, we're heavy users of Twitter. You're welcome to follow me. My handle is @BrandonVanZee, and we'd encourage you to click like and retweet if you get value out of these Market Outlook videos. Lastly, we are also on Facebook. Feel free to join our group in the web address embedded in the logo in front of you. All right, with that, let's go ahead and dive into today's analysis. As you can see, I've got chart 4B pulled up here in front of us for those of you that are premium market scholars that want to follow along at home with your own charting package. Now, as a reminder, this particular view here, this is called a 4-grid here, and we're looking at the S&P 500 in the upper left, Dow Jones Industrial Average in the upper right, the NASDAQ Composite in the lower left, and the Russell 2000 in the lower right. And each one of these charts represents 3 months in length. Each one of the candles that you see on the charts represents 1 day in length. And so as we look at this, you'll probably notice the background colors of the chart. They tend to stand out. And what stands out right now is that we continue to be green. In other words, the background color behind today's candle is dark green in all 4 of these charts cases, which is reminding us that from the market forecast indicators perspective, we have a bullish posture. Now, unless we say otherwise, what we're looking at when we're determining that is what's going on with the green line, which is the most used market forecast line for intermediate term trend traders. And as you can see here in the case of the S&P 500, that line is way up here in the upper reversal zone. In fact, our labels will tell you exactly where it's at currently, 96.87 and falling for the S&P 500. Now, that falling aspect of it might be a bit concerning to some, but remember, as long as we're in the upper reversal zone, and that upper reversal zone on the market forecast indicator is anything above 80, as long as we're in that upper reversal zone there, we would consider that to be bullish no matter whether the line is rising or falling. It's when it falls out of the upper reversal zone where either the rising or the falling has some sort of an impact on whether we'd be bullish or bearish. So keep that in the back of your mind. Now, this has been a very good run that we've been on here for the last couple of months. You can see that we've really been bullish on the S&P 500 since going back here to one of the first sessions of January, and have continued to be bullish ever since. I bring that up because this has been a very healthy exhale. And remember, markets that are properly working oftentimes need inhales and exhales in order to have a healthy market environment. And we really haven't had much of that. but part of the reason behind that is the condition that we started in, which is back here maybe we had too much of an inhale without much of an exhale when the markets were going down every single day. So we kind of have the reciprocal of that, where we see markets then responding right back the way that they came from prior to that move. So where we stand right now is maybe a little bit concerning, simply from the aspect of we've gone into a bullish posture for so long, and they usually don't last all that long. But in addition to that, where we stand right now is at a key resistance area on the S&P 500. Now remember, the path of least resistance continues to be to the upside. All you need to do is look at that moving average to determine that. But obviously that doesn't guarantee anything. We also need to look at price action. And if there was a big seller of the markets back here on December 3rd, they could potentially still be sellers of the market. We have not breached those levels yet. So that will be an important area for a lot of market watchers to kind of hone in on and try to determine their next best decision in the markets. Now, one thing that I did mention last time I did the presentation on Tuesday is on the NASDAQ and the Russell 2000, we've already gone up and over that level from December 3rd. So from those perspectives, we've already gone through resistance. So while they have gone up at the same kind of pace and rate that the S&P 500 has, they at least can make the claim now that they've taken out that potential resistance area that was formed back there, whereas we can't really make that claim on the S&P 500 yet. One other thing I should point out as well is that the Dow, when I did the video 2 days ago, it had not taken out its prior high, but since then, as of yesterday, it looks like it did have its high. So really, of these four major equity indices here, it's only the S&P 500 that remains below that prior high. But keep in mind, the S&P 500 is probably considered the most important of these indices here, at least according to most. It is one of the most widely tracked benchmarks on the planet. So it's a very important one, and we'll be watching it closely as things go along. One other thing that I did want to kind of point out here is that we do have what's known as a bullish intermediate confirmation signal on the Russell 2000. And so let me right click on this chart and then go to maximize sell so you guys can see this a little bit better. This is the Russell 2000. Remember, this tracks small cap stocks here in the United States. And a bullish intermediate confirmation signal exists when we have a bullish intermediate posture. And remember, you can look at the background color of the chart just to determine whether we have a bullish or bearish intermediate posture. Right now, we do have a bullish intermediate posture. The background color is green. That is occurring because that green market forecast line is in the upper reversal zone. Now, remember, it would also be considered bullish like it was back here when that green line was just simply rising. Okay, so either one of those conditions can be part of this bullish intermediate confirmation signal. So that's step one, identify whether we have a bullish intermediate posture or not. Right now we do. Step two is a little bit more specific in that this red momentum line right here has to be in the lower reversal zone. It can't be just a thing where it's falling or anything like that. It has to be in the lower reversal zone. So that's the other check mark there. We have those two conditions that exist on the Russell 2000, and oftentimes people use that as kind of a buy the dips mentality. Now, right now, you might be thinking to yourself, that's not much of a dip, is it? And it really isn't, right? We're only down 0.39% here today. But with a little bit of perspective, you can see why a technical indicator may suggest that we are at the beginning of a potential pullback or a buy the dips type of a moment, because we've just gone up 1, 2, 3, 4, 5, 6, 7, 8, somewhere in between 8 or 9 days in a row to the upside. So if there was someone along the way that recognized this uptrend and was waiting for a buy the dips moment, they haven't received it. So today we actually did get a red candle, and it's the closest thing to a buy the dips that you've been able to see in the last 2 weeks for the Russell 2000. Now, one thing I will point out regarding this bullish intermediate confirmation signal is that the blue line is way up here close to the 80th percentile. What we've noticed in the past is that these bullish intermediate confirmation signals that seem to do the best are started when that blue near-term line is positioned between 50 and 20, somewhere down in this area that I'm kind of circling with my mouse right here. So that kind of throws a little bit of a fly in the ointment. Technically, we still have the bullish intermediate confirmation signal, but it's not what we would consider an ideal setup because that blue line kind of needs to exhale a little bit more. So that means perhaps we get another day or two to the downside with the Russell 2000 before we get a little bit more of that element of buy the dips. All right, let's take a look at our next charts. This one's going to be our 3 green arrow chart, and this is our chart 4C. Same thing as I've mentioned before, things are looking pretty rosy here for the most part. We do have 3 green arrows on most of these charts. The only exception to that is down below here on the NASDAQ. Notice that today we did receive a red arrow on the MACD telling us that momentum is waning a little bit, and that makes sense. You look at that chart right there, if I right click and maximize the sell, we've really been tracking sideways for the last 4 days right here. So the momentum that kind of pushed this market higher in the first month and a half of 2019 has dissipated just a little bit. Now that doesn't mean that it has to wreck the trend and then all of a sudden we're in some sort of a bearish move, but it is a reminder that stocks don't go up every single day, and eventually they'll move out of that momentum swing that they've been in. And right now could be one of those times. However, I will caution you to be a little bit careful with that thought, because we have had several changes of momentum, as you can see down here on the MACD. Ever since February 11th, we had a red arrow, green arrow, red arrow, green arrow, and now red arrow again. So we have a lot of back and forth activity there, where it's almost as if the market can't quite decide if it wants to have momentum to the upside or to the downside. So right now it looks like it's got a little bit of a negative bent to it, but it's not to say that it can't go and immediately put in a green arrow the very next day like it did back here. Now that's not normal. You'll notice that, you know, back during this time period, you had several days and in many cases several weeks before you would have a change in the green and the red arrow. So what we have been seeing here in the last couple of weeks is a little bit abnormal, and it's just a little dicier because, you know, you don't feel quite as confident knowing that the market is going to have that momentum to support your trade. Let's take a look now at our 1040 crossover chart. This is chart 4D. And as you can see, we do have a bullish crossover that currently exists on the Dow Jones Industrial Average. You can spot that very quickly because we see that that green background color of the chart is now appearing off to the right. However, we don't have that yet on the Russell 2000, on the NASDAQ, or on the S&P 500. So we're getting awfully close in many of those cases, especially the S&P 500. Notice that MACD2 line just below it. When that black line gets up and touches that pink horizontal line down there, that is basically when these two moving averages are touching as well. And remember, we're looking at 3-year charts here. Each one of the candles is 1 week in length. And when you're looking at the colors of the moving averages, you can use kind of your labels up at the top to recognize that. But just to make sure we're clear on it, the orange line is the 10-period exponential moving average, in this case the 10-week moving average. And remember, that's going to be more sensitive than the blue line, which is going to track a lot further back as far as the amount of information that's going into calculating the moving average, in this case 40 periods, or in this chart's case 40 weeks. So the orange line is going to be more sensitive than the blue line, and it's going to move around with a lot more force on both the upside and the downside. Right now, we've got an upswing because prices ever since late last year have largely been going higher. And so these moving averages, which are lagging indicators, are starting to then kind of respond to that strong price movement. And so it wouldn't surprise me at all if markets continue to behave themselves here, if we would get the S&P 500 to join the Dow Jones Industrial Average with a bullish crossover at that point. And then, you know, the goal is to have a strong trend after that. Now, as I mentioned on Tuesday, we can't necessarily expect that in this case because, after all, we're in about a 9 or 10 year bull market at this point. And so it would not be normal. Now, there is no rule book to the stock market. The stock market will do whatever it needs to do. There is no such thing that says a bull market can't go on for 20 years or 30 years. It's highly unlikely because it has never happened in history, but nonetheless, it's not impossible at the same time. So we have to account for that. But you can see that the last time we had a bullish crossover on the S&P 500 was way back in early April of 2016, and had you gotten involved in the markets at that time, you had some really healthy gains awaiting you until we finally got a negative crossover there. So I find that interesting, and we could very well see a golden cross on the S&P 500 here within the next couple of weeks. Let's take a look at our next chart setup now. This will be our intermarket analysis 12 grid. And as a reminder, the background colors of these charts will tell us whether we have a bullish or bearish posture using the market forecast indicator on each of these charts. And I'm talking specifically about the intermediate line on the market forecast indicator. One thing that does catch my eye right out of the gate, because I've been kind of watching it like a hawk so far in 2019, just more than anything fascinated with it, is gold. Gold down below here remains a very, very strong chart. However, today was a pretty ugly day, so what that means going forward, hard to say. For those of you that felt like you've missed the gold train so far in the last several months, perhaps today is going to be the first piece of a little bit of a pullback where you can establish some more intriguing entry prices. You know, the way that I would kind of look at it is, as long as we continue to trade above a rising moving average, in this case it's the 30-day moving average, I would assume that the path of least resistance continues to be to the upside. So if we do find that this 1.6% move lower on gold today leads to another couple of days of downdraft, but then we start stabilizing above that rising moving average, and then we start bouncing above it. You know, some of you have heard us refer to the acronym CAHOLD, or a close above the high of the low day. That's what we'd be looking for around that bounce area. You know, for instance, back here, we came, kind of had this nice move into the year end, and then we stabilized by going sideways with gold. It pulled back a little bit, touched that moving average, didn't breach it to the downside, and then bounced significantly off of that. And then that led to further upside gains here. So we're going to keep our eye on that and see if maybe that could set up for us going forward as well. Unfortunately, the story is completely the opposite for agriculture commodities as opposed to gold commodities. Notice right here, ag commodities cannot get out of their own way. They continue to be bearish from a posture perspective, but just as importantly, they continue to form a series of lower highs and lower lows. And so this is an area of the market that if you're looking for bearish trade setups, perhaps you're going to find something of interest there. But right now, it's just too early to call a bottom in agriculture commodities. If that is your mindset and you're looking for bottoms that have been formed, perhaps crude oil, which is the chart in the lower right-hand corner here, will get you done, because that one did have kind of a flush out type of a moment at the end of last year. We got all of those oversold clusters. Then we really started stabilizing there, and notice that it wasn't too far into the new year, really within the second week, we started seeing price above a rising moving average, and that is what we are seeing here for the vast majority of 2019. So there is that potential for, you know, a little bit of that bottom fishing there in not only oil itself with the commodity, but also a lot of those energy stocks that have been kind of beat up as a result along the way. Other areas of focus here can be, you know, something about the VIX. You know, it's worth mentioning that it did rise 3% today. However, we haven't been talking about it as much because it really has been par for the course. It continues to just dwindle lower and lower and lower. And despite the fact that it's up 3% today, it's still basically at 3-month lows. So I wouldn't get overly worked up about that. Remember, the VIX does work a little bit more strangely, I guess you would say, than a lot of other charts where you don't have traditional trends per se. You have huge juts out of nowhere like we saw right here. So you can't quite as easily conduct technical analysis on the VIX itself, but it does give you at least a heads up as far as our options prices considered cheap or expensive right now. And right now, most options prices would probably be considered a bit on the cheap side of the equation since that VIX has struggled. All right, let's go ahead and now take a peek at our next chart setup. And this will be our foreign stock markets, chart 4F here. And as you can see, there are more green charts than pink ones, telling us that more of these foreign stock markets have a bullish posture, according to the market forecast, than those that have the bearish posture. But nonetheless, you know, there's a variety of things to look at here. You know, India kind of represents an interesting chart where if you're looking for a bearish trade, I think it can make some sense to look at it now that we've had that reversion to the mean type of a move. So this is a chart that I've been pointing out here recently that, you know, has been catching my eye from the negative perspective because not only was it one of the few foreign markets out there that had a bearish posture, but it was basically the only one, at least out of these 12 that we look at right here, that was trading below a falling moving average, right? We do have South Africa down here below a moving average, but that moving average is still rising, so there's still kind of that last second hope that it'll correct itself and start working its way higher. Right now, the path of least resistance on India is to the downside. Now, depending upon your mindset and what you've had success with in the past, some of you might be bounce traders, some of you might be breakout traders. When it comes to shorter term, more active trading, I actually kind of prefer the bounce mindset myself. And so I'm a little bit leery when we start seeing, breakdowns like we did with India here about a week or so ago. But now that we've had 2 days to the upside, notice these two candles right here, we still remain below that falling moving average. We still continue to have that bearish posture. So the benefit of putting on a bearish trade here as opposed to doing it down here is your pricing is going to be better up here. So this one could be very interesting. I don't know how liquid the spreads are on something like the India ETF here, but remember that there are ADRs, individual ADRs that are traded from India that are available to us in the United States as well. So perhaps you could find some bearish trades there with some of those. But for the most part, many of these other foreign markets are holding up reasonably well. In fact, worth noting as well is China is basically at 3-month highs. Of course, China very much in the news flow with the trade talks with the United States, but basically put in that 3-month high yesterday, had a little bit of a give back here today, but nothing to get too concerned about at this point. We still remain above a rising moving average with that bullish posture right there. Let's now take a look at our next chart setup, which will be chart 4G. This is our US version of the 12 grid here. Now, the way that you look at this is the S&P 500 is the chart in the upper left. All the other charts that you see here are the 11 sectors that make up the S&P 500. We actually had a question about these types of sector ETFs today in my question and answer class. So give me a moment here to kind of address that as well and remind those of you that are premium market scholars that if you wanted to kind of get some of my insight and some of my analysis on some of these topics that you see that we covered here from our students today, you can see that I did an analysis or a review on AbbVie. We talked about PE ratios and how to interpret them and some of the things that you can do to kind of absorb them and understand them a little bit better, how to evaluate them, and then also what some of the pitfalls are. We also took a look at Prudential here today, and then there was Irv's question right there that I was mentioning when we were talking about the selection of ETFs for a sector basis there. We also talked about CVS, the drugstore company. We talked about Graco, GGG. We talked about Kellogg's. We talked about some SEC forms that you're going to find on the Edgar website with Form 4 and what that means, if anything, when insiders are selling stock. And then we also had a conversation about Kimberly-Clark. So feel free to check out that recording that is now available on our events calendar if you are a premium market scholar. Also, since I'm out over here on the internet, just a friendly reminder that if you do get value out of these free YouTube videos that you're watching right now, we would encourage you to click like on your various social media outlets. We try to make that nice and convenient for you by posting not only the video on our website in the blog area here, but also posting a link to Twitter and also Facebook for you to easily just click on it from our website and give us a thumbs up or a like there if you so desire. Again, that helps us get the word out and encourage us to continue to develop these free videos on a daily basis for you guys going forward. Remember that tomorrow, David has his very popular technical analysis trading room coming up at 11 a.m. Eastern Time. I'm always fascinated with that particular trading room because David does a great job bringing in a brand new technical indicator almost every single week, and then taking a deep dive on how to interpret that, how to use it from a practical perspective, and place trades with that information. So again, if you are a premium market scholar, we'd encourage you to attend not only that class but all of our trading rooms here. Let's get back on track with some of our analysis on the Thinkorswim platform now. I did want to point out that the communications sector was the only one that currently has that pink background color that tells us that we have a bearish posture using the intermediate line on the market forecast, because it is just barely, and notice up here in the label it says 79.93 and falling. And remember, the only way that we have a bearish posture is if we see that line fall out of the upper reversal zone, which remember is at 80.0. So 79.93 is about as close as you can get. So in other words, this had to have just turned to pink here today. Remember, you can right click on the charts and go to maximize sell, and then down at the bottom you'll see the actual market forecast itself, so you can kind of visualize that a little bit better. But that's what I'm referring to. That green line fell just barely out of that upper reversal zone, so technically we do have to consider this one weakly bearish at this point. But remember, when you're so close to that upper reversal zone, you could really see that turn right back to a bullish posture as soon as tomorrow, so you don't want to kind of overdo it with that type of analysis at the same time. Otherwise, it's pretty smooth sailing here with most of the other areas of the market. You'll notice down below that the utilities had a really nice day. They were up 0.73%, and we are approaching our prior highs here from December there with utilities, which has been an area that I've actually been focusing on quite a bit in my classes this week. We talked about the utilities sector in my dividend growth investing class on Tuesday, and then we talked about it again last night in my strategy lab class. So starting to see some positive price momentum out of those traditionally very boring utility companies. However, we will want to make sure that we're keeping our eye on this potential resistance area right on over here. But otherwise, you know, things look reasonably strong out there from a sector perspective, at least here in the United States. All right, let's now talk about our trade application example. And for it, I wanted to bring up, first of all, chart 3A. And this is our dividend stair-step chart that we use in my dividend growth investing class on Tuesdays. And it gives us a real nice visual to be able to determine whether we consider a stock's dividend yield to be attractive or not. And how we determine whether a stock's yield is attractive or not is judging its current yield versus where is the stock historically what is the stock historically yielding when its price is bottoming out. So in other words, the way that you would look at this particular chart, and I've got ticker symbol MO here, this is Altria, the big cigarette company, when the stock comes down to this orange line or below, we would view this as attractive because it would have a current yield in excess of its average high yield, which we're averaging out over the past decade. And you can kind of eyeball it as well by just simply looking at the chart and asking yourself, okay, if you had invested in this company in the past, where would you wanted to invest? And of course, the answer is usually you want a lower price, right? The lower the price you can buy and then watch that stock go up, the better off your profit margins are as an investor or as a trader. So as you can see back here, we had times like right here that I'm pointing at in August of 2011, where MO's share price fell to a level where its dividend yield was then high enough to consider purchasing under this mindset. And that occurs when price is at a level where its yield is 6.04% or higher in this particular case. Remember, every single company is going to have its own unique average high yield. So for MO specifically, that number at this current time is about 6.04%. So that brings us back to where we're at right now. You'll notice that in the vast majority of recent years, because this is a 10-year chart that we're looking at here. So, you know, if you're looking at this time period basically between, let's call it 2013 and 2018, notice that price was way above these orange lines. It kind of got a little bit distorted from what are its normal tendencies from a yield perspective were. Well, that has unraveled. And as you can see, price has now gone down quite a bit for ticker symbol MO. We now have a series of lower highs and lower lows. Now, in order to establish a long-term position, some investors might be willing to kind of roll the dice a little bit and say, okay, I recognize that while we have a longer term downtrend in place, at least we know that from a historical perspective, this is an attractive starting yield for this particular investment now that we have a yield in excess of 6% for MO. So that is somewhat attractive on this, assuming that you don't think MO is going to be cutting their dividend anytime soon. And since they have a long, illustrious history of raising those dividends, most people probably do not. So from a yield perspective, it becomes very attractive. I also want to show you real quick here on chart 4A, which is just the market forecast one grid here, and this is going to be on a 3-month daily candle chart. Type in ticker symbol MO, and you'll see that despite having a really ugly end to 2018, it has actually done a reasonably good job of stabilizing from a price perspective here recently as well. So some folks would say, well, I recognize that the dividend yield is attractive, but I'd really like to see some stabilization, some signs of bottoming from the stock's price itself. Not everybody thinks in those terms, but many of you might, because you're probably a little bit more on the technical analysis side of the equation, those of you that watch this particular video. And so from that perspective, at least we have some signs of hope here as well. As you can see, we started trading above the moving average when it reported earnings back here at the end of January, has largely gone sideways for the last several weeks up until yesterday. We had kind of a little bit of a breakout day there on MO yesterday, and while today was down a little bit, at least it held most of those gains that it put in yesterday and is now trading at a level that you'd have to go all the way back to this candle back on December 20th to have experienced last. So it's kind of trying to do its best to correct itself to the upside. So what I thought we would do here today is sell a put on this. With the idea of if it does go down in the future, we'd be happy to take ownership of at least 100 shares of MO. And if it doesn't, then we just simply get to keep the premium that we receive when we sell that put. So I'm going to come on over here to the trade tab. Got ticker symbol MO pulled up here in our little box up here at the top, and we can see the option chains pulling up down below. I am going to go out to the April contracts with 56 days left until expiration, and usually what I do is I look for a return of risk or a return on risk of at least 1%. In this case, we don't really have one. The closest one that we have is the 45 strike. So admittedly, this might not be ideal for some of you. You might want a much juicier premium. And if that's the case, perhaps you would be a little bit more enticed by the 47.50 here, where you can get over 1% right there. But if you're not convinced that MO is done bottoming at this point, perhaps you'd be willing to accept a slightly smaller premium in the hopes that your starting cost basis would be down at $45 per share as opposed to $47.50. So there is no right or wrong way to handle that. It just merely comes down to your perspective and how aggressive you want to be when implementing this trade. We will choose to go on the conservative end here, and we'll get that return on risk, hopefully of about 0.89%. So I am going to simply click on the bid price there. That loads up our trade. We'll just simply do one contract here at this point. Again, it's selling the $45 put there in April on ticker symbol MO. And I'll click confirm and send, review that one last time, and send that one into the market. But hopefully we'll see if we can get that filled first thing in the morning. All right, well, I want to thank you for joining me here tonight. Always a pleasure to go to work for you. Remember, David will be with you tomorrow, and then I'll have you with most of next week since he'll be on vacation. So have a great rest of the day. Have a great weekend as well, and we'll see you all next week. Take care, everybody. Bye-bye.